Advanced Financial Accounting OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to estimated annual tax rate. Get ready to account with Advanced Financial Accounting. Here we are in OneNote. If you have access to OneNote and would like to follow along, you're not required to do so in order to benefit from this, but if you have access and would like to follow along, we're in the 1319 Estimated Annual Tax Rates under the Problem Presentations section. I'm going to close this back up then. We're going to be working through all the data. We'll take a look at the information for the problem first, reading through all the information for the problem. Then we'll take a look at components of that information that's related to the current piece of the problem, the calculation that we will be working on piece by piece. So we're going to be looking into the estimated annual tax rate. Now what we need is an estimated annual tax rate because we're thinking about interim financial reporting. So if we're reporting for a quarter reporting, quarterly reporting, or something like that, we have less than a year that we are reporting for. So some of the problems that we have to deal with then is the fact that the tax rate is applied on an annual basis. So how are we going to estimate the taxes that are accruing, that are happening as time passes for the first quarter when it's an annual tax rate? So we're going to have to make some kind of estimate on the annual income that we're going to make. It's also a progressive tax, so it's not a flat tax. So we can't just apply the rate that would be for the first quarter, because it would be too low, because we first have to annualize the taxes to figure out what the annual tax rate would be. And then we also need to think about the tax rates for all income taxes. So that would be both federal income taxes, state income taxes. If we have any other local or foreign, income related taxes, we may need to consider those. We're going to be looking here at a combined rate here for the federal and state income taxes. Also note that this tax rate that we're gonna have to estimate then, this estimated tax rate for taxes is going to be on taxable income. And the taxable income will differ from the book income that we're going to be taking a look at when we do financial reporting for the quarterly basis. So we'll have to take that into consideration. Also, if there's any credits, tax credits, those are not included in the taxable income. They're imposed afterwards. So this tax rate doesn't include the effect of credits. And we would like to come up with some kind of rate, some kind of method that we can use, an estimated annual tax rate of some kind that we can apply and take into consideration the effect of the tax credits as well. So we have the estimated federal and state taxes that we're expecting on the total income at the end of the year for federal and state taxes on the taxable income. Then we have the expected annual pre-tax earnings from continuing operations. So this is the expected annual pre-tax earnings, the annual earnings for the entire year, not an interim period, and their pre-tax $1,300,000. Expected differences between tax income and financial statement income. So we think these are going to be some differences that we will have to take into consideration. So when we apply our tax rate, we're going to have to take our estimated book income, right, that for a year that we have now annualized, and we're going to have to adjust it for the difference between the book income and the tax income that we're going to have to consider on an annual basis. So we're projecting out the annual income, net income or tax, net income, and then we're going to be adjusting for the differences between the book and tax. So we have a dividend exclusion for dividends received on the company's stock investments, $90,000. We're going to have to adjust for tax exempt income received, $30,000. Premiums from life insurance on officers, where the company is the beneficiary, $14,000 that we'll have to adjust for. Then we have the business tax credit of $41,000. Then we have the first quarter pre-tax earnings. So the earnings for the first quarter, $189,000 for the quarter. Earnings includes a loss from discontinued operations before any tax effect, that being the $31,000. We'll have to make an adjustment for that. Estimated effective combined federal and state tax on income from continuing operations for the year. Okay, so we're going to start off with the estimated income taxes for the year. So remember, what we have to do then is basically annualize this thing for the year, and then we'll make some adjustments to bring it to taxable income. Then we'll think about, apply the tax rate to it, and then consider our credits so that we can then take that information and use it for our quarterly estimates that we will be making. All right. So we've got income from the continuing operations from our data. This down below is going to be another set of our data here. a little bit smaller so we can see it. So we got the expected annual pre-tax earnings was 1,300,000. So that's going to be our starting point. We've annualized it. Now remember, we're in the middle of the year, right? So we had to annualize that number. So that's given to us here, but we would have to obviously project that out. Then we're going to make the adjustments for permanent differences. So this is going to be differences between the taxable income and the book income. This being the book income that we have projected out. We're in the first quarter. We annualized it so that we can make these calculations. Then we're estimating that the premiums for the life insurance is going to be a permanent difference of 14,000. So if we scroll down here, we see in our data, we had premiums for life insurance on officers where the company is the beneficiary. So we deducted that for book purposes. We're not going to be able to for tax purposes. It's a permanent difference. Therefore, we will add that back. Then we have the dividends exclusion. So once again, down here, we see in our data, we had dividends exclusion for dividends received on the company's stock investments. So that is going to be an item that we're going to have to subtract back out because it's not going to be included in income for taxes. So it's included in this number as income, not for taxes. We're going to remove it. Then we've got the tax exempt income. Once again, if we scroll back down, we had tax exempt income down here as we're projecting out that we will have part of the income in this 1,300,000 be tax exempt income. And therefore, for tax purposes, we're going to remove it, decreasing that amount. So we're going to say, all right. Then we have the adjustments for the permanent differences, which is going to be the 14,000 minus the 90,000 minus the 30,000. So we have a decrease from what our original basically net income number was. So we've got the 1,000,003 minus the 106, and that's going to give us to our estimated annual taxable income from continuing operations at the 1,194,000. Then we're going to take that times the combined tax rate. The combined tax rate given to us here, estimated and federal tax rate is the 45,000 combined or 45%. So the 1,194,000 times 45% is going to give us an estimated annual taxes before any credits of the 537,300. Now, in practice, you might have a difference due to rounding or something like that. It's an estimate, so rounding is okay because it's not a perfect number here. So we got the 537,300. Then we have the expected business credits. We said that we expect there to be credits as well. That was given down here, business tax credits. And so we annualized the credits, and of course those credits aren't included in the taxable income or the calculation, or this 45% isn't taking into consider the credits, and we want to come up with some type of percent that will, so that we can make an estimate on a quarterly basis which will include the credit. So we're going to say, all right, let's subtract out the credit. Now we've got the 57,300 minus the 41,000 credit. We have the estimated income taxes for the year then, projected for the year, estimated income taxes totaling 496,300. So then we're going to take that information and figure out the estimated affected annual tax rate. And the way we'll do that is we'll take the tax, we're going to do a division problem, the 496,300, and we're going to divide it not by the taxable income, but by the book net income, right? Because that's what we have on a quarterly basis. So by doing that, we're going to come up to a rate that we could basically apply to the quarterly net income amounts, right? So I'm going to take this 496,300 divided by the 1,000,003, 130,000, and that's going to give us about this 38.18. So it's rounding. So notice rounding will be involved here. And because we work this in software, notice that the round, it's going to use the actual number here when we do the calculation on it. But it is, of course, an estimate that we are using. So this isn't, when we think about estimates, it's not a perfect thing. So rounding is okay, with an estimate. So that's going to be our estimated effective annual tax rate. Now we're going to go down to the first quarter tax provision for continuing operations. We're going to do our calculation here. So that's going to be total pre-tax earnings, the total pre-tax earnings for the first quarter now. So now we're backing into the first quarter. This is where we actually are at this point in time. The calculation we did before being a projection. Now we're going to apply the rate that we came to with what actually happened. So we know these numbers. The first quarter, we know them for sure. These are actual numbers. This is the $189,000 that was given to us here, first quarter pre-tax earnings. Then we have the extraordinary loss that is reported separately with its own income tax effect. And we're taking into consider that item here. The earnings excludes a loss. The earning includes a loss from discontinued operations before any tax effect, which we're now going to remove. So we're going to say the extraordinary loss that is reported separately with its own income tax effect, we're going to add back in now. So the 189 plus the 31,000 is going to give us the first-quarter income from continuing operations, which is going to be the 220,000. Then we're going to apply then the estimated effective annual tax rate, which is at 38.18 about. It's really this number or something closer to this that will then apply and multiply times the 220,000, and that's going to give us about the 83,983. So note here, what we did is we applied this tax rate. We were able to apply this tax rate not to taxable income, not then apply the credit after we do it, but we got this rate that we're applying just basically to the first quarter income from continuing operations. So that's what our goal of this calculation up here is doing, because remember, the tax rate that you think about, the actual tax rate is on taxable income, doesn't take into account the credits, and we have these changes between book and tax income. The rate that we come to, the 3818 estimated effective annual tax rate, is then an attempt for us to come up to a rate that we can take into consideration the credits that are going to be involved and the difference between book and tax, so that we can apply it to interim quarter, the first quarter in this case, and apply it to the income from continuing operations. Okay, and then the journal entry, if we were going to record the journal entry, would be a debit to income tax expense. In the first quarter, we'd have the adjusting entry for the income tax calculation and a credit to the income tax payable at that point in time.